Good morning, everyone. So today we are going to talk about a new chapter, and the title of the new chapter is Accounting for Corporations. So this is our new chapter. So what is the accounting equation for the corporation accounting? It is something like assets equal liabilities plus stockholders' equity. So this is the accounting equation. This is the accounting equation for a corporation accounting. But in this chapter, we are going to focus on mainly this part. We are going to focus on mainly the stockholders' equity section. So although this is the accounting equation for the corporation, but we are not going to talk every part. We are only going to talk about the stockholders' equity because last chapter, we already talked about the liabilities, right? Last chapter, we already talked about the liabilities. And what about the asset? You learn your principles of accounting 1. So we are going to learn in detail about the stockholders' equity in this chapter. So I can modify this equation like this. So here before it was the asset equal liabilities plus stockholders' equity. Now, as we are only going to focus on stockholders' equity, so the stockholders' equity equation is stockholders' equity equal assets minus liabilities. So this is the accounting equation for corporation, and this equation is for stockholders' equity. So how to explain this equation? The stockholders' equity equation, how to explain it? It means that after paying all liabilities from asset. So you have asset, right? You have asset, for example, $100,000. You have asset $100,000, and from this asset, we have to pay our liability first. For example, liability is $30,000. So we are going to pay our liabilities from asset, and remaining goes to stockholders' equity. What is the remaining amount? Remaining amount is $70,000. So remaining amount goes to stockholders' equity. Clear? So this is the asset accounting equation, and this is the stockholders' equity equation. Now we are going to talk about different components of stockholders' equity. Now look at the previous part of the equation. So here you know that this is the accounting equation, right? This is the accounting equation, and this is the left side of the equation, and this is the right side of the equation, right? You know that. And the principles of accounting 1, you learn that the left side of accounting equation is called debit. The left side, okay? The left side of accounting equation is debit, okay? And the right side of accounting equation is credit. That means liabilities normal balance credit. Liabilities normal balance credit, and stockholders' equity is normal balance credit. So this is the important concept you should learn from your principles of accounting 1. Okay, asset equal liabilities plus stockholders equity. This is the accounting equation, and left side of accounting equation is called debit. Okay, left side of accounting equation is called debit, and right side of accounting equation is credit. So here we have two components in the right side. That means liabilities normal balance is credit, and stockholders equity normal balance credit. So this is the normal balance. Okay, so that means that normal balance of assets debit, the normal balance of liability credit. Very, very important concept in accounting. Normal balance of asset debit, normal balance of liability credit, and normal balance of stockholders equity credit. So it came from the accounting equation. It came from the accounting equation, and this is the accounting equation. This is the accounting equation. Now, if we talk about separately, stockholders equity equal assets minus liabilities. It means that after paying all liabilities, remaining goes to the stockholders equity. So stockholders equity means you are the owner, right? So business first pay all of their liabilities, and after paying liabilities, owner will get the money. Now we are going to see what the components of stockholders equity. Let's see. So let's see the components of stockholders equity. For example, this is stockholders equity. And the total amount of stockholders equity, for example, $90,000. For example, total stockholders equity is $90,000. That means the shareholder is going to receive this money. Now, how this money came from? Because this account includes several components. Okay. So which one is the first components? Let's see. The first components is about called paid in capital. Paid in capital is the first component. And if this column is about normal balance, so what is the normal balance of stockholders equity? I already mentioned to you, right? So normal balance of stockholders equity came from the accounting equation. It is credit, right? Okay, so the normal balance of this column is about the normal balance. So we know stockholders equity, the normal balance is credit. It is credit. Now, who are the components? The first components here is the first components here is paid in capital, and Here, second component, additional paid in capital. Then third component, retained earnings. And fourth component, treasury stock. Okay, so we assume that these are the four components. These are the four components of stockholders' equity. So this is the total amount. Look at here. This is the total amount. The total amount is $90,000, and this total account include these four components. These four components. Okay. Now look at their sign. Look at their sign. So this is plus sign. This is additional paid in capital plus sign, retained earnings plus sign, and treasury stock minus sign. Minus sign. It means that how we get this money, $90,000. $90,000 came from paid in capital, okay, plus additional paid in capital, plus retained earnings, minus treasury stock, okay, equal this $90,000. Okay, equal this $90,000. So if you understand this, and stockholders' equity normal balance is credit, okay, can you tell me what should be the normal balance of paid in capital based on this relationship? Because this is a stockholders' equity, right? A stockholders' equity normal balance credit, right? And how this amount came, paid in capital plus additional paid in capital plus retained earnings plus treasury stock minus. So if this is the case, what should be the normal balance of paid in capital? It is debit or credit? Debit? Anyone? Credit, yes. Thank you very much. Credit. Because look at here, credit and credit, it is plus, right? Credit, credit plus, but debit, credit minus. You know that, right? So paid in capital normal balance should be credit. So what should be the normal balance of additional paid in capital? Credit, yes, because credit, credit plus, right? Then what should be the normal balance of retained earnings? Credit, yes. So we find that they are credit. Why they are credit? Because they have positive relationship. They have positive relationship, right? Positive relationship. But what about treasury stock? The relationship is minus. It should be debit, yes. So this is very, very important accounting concept. Okay, so debit plus, okay? Debit plus, credit plus. But when they came debit and credit, they have negative relationship. Okay. So you understand that stockholders' equity credit. So paid in capital credit, additional paid in capital credit, retained earnings credit, treasury stock debit, right? Now we have some components under paid in capital. We have some components under additional paid in capital also. So there also should be credit, right? Yes. So paid in capital, first component is called common stock. So in the second chapter, I already explained what is common stock, what is preferred stock, if you remember. So in our long-term liability chapters, when we calculate earning per share, at that time I already explained how to calculate the dividend for common stock, how to calculate dividend for preferred stock, right? So at that time I already explained clearly what are the differences between common stock and preferred stock. So these are the two components. Okay, these are the two components of common stock. Sorry, paid-in capital. So these are the two components of paid-in capital. So paid-in capital credit means their components also credit. Clear? Because we find that paid-in capital credit, right? It means their components also credit. So common stock, you should write always credit. Okay. Then prepared stock, you should write always credit. So paid-in capital credit, so their components also credit. Okay. Now we can see some examples. For example, company sell $1,000 shares. Okay, company sell 1,000 shares, and par value is $10. Okay, company sell 1,000 shares. Company sell 1,000 shares, and the each share price, okay, each share price is $10. The par value. Par value means the value mentioned on the price and the share. For example, this is a share. Okay. So here there is something mentioned, the price. So this is called the par value. So company sell 1,000 share, par value $10, and it is something like $10,000. $10,000. And company sell preferred stock. Okay. Company sell preferred stock, and maybe company sell 1,000 shares, and the par value may be $40. Do you understand? Company sell common stock, company sell preferred stock. They are going to which side? When we record the journal entry, they are going to be recorded in the credit side, right? Because they are the part of the paid-in capital. So we know that paid-in capital is credit. So their components are also credit, right? So whenever you will record journal entry, you should remember this. Very, very important for journal entry, this part. This part. So you see that we record common stock credit, okay? We record common stock credit, which amount? Don't forget that par value. What is the meaning of par value? We record preferred stock in the credit side with par value. What is the meaning of par value? Par value means the price mentioned on the share. Okay, so when you go to the market, you want to buy something, and if you get one product from a shopping mall, you will see that there is a price written, right? A price is written over there. Same, it is called the par value. When company sells share, company decides the price of the share. So don't forget that always we record par value when we record preferred stock. We always follow par value when we record common stock. Okay. Now then, what is additional paid-in capital? What is additional paid-in capital? You know that if you sell something, you may have gain, you may have loss, or you may have no gain, no loss. Okay. You may have no gain, no loss. So look at here, for example, additional paid-in capital mainly is about gain and loss. Okay, so additional paid-in capital is about gain and loss. Is about gain or loss. So can you remember our long-term liability. We sell our bond with premium, we sell our bond with discount. Can you remember? So if you sell premium, okay, it is your gain or loss. You sell your product with a premium. If you sell your bond with premium, it is gain or loss? Gain, right? Yes, so premium. Okay, if we sell our share with premium, it is our gain. Okay, it is our gain. And if we sell our share with a discount, it is our loss, right? It is our loss. Very good. Now, how to understand we have gain or loss? Look at here, the par value, for example. Par value according to this example, $10. Okay. You sell common stock or preferred stock anyway, the par value $10. However, market price from market you receive $15. Do you understand? So premium, our gain. So the par value of our share is $10. Okay. Par value of our share is $10. That means market price is higher, right? Our par value is lower, but when we go to the market to sell our share, we receive $15 from market. Do you understand? Understand this? Now $10, look at it. So $10 we already recorded here. $10 we recorded already as a common stock, right? And what is the difference here? The difference here is the $5, right? So difference here is the $5. $5 is the difference. That means you receive additional $5 from the market. Your product price is $10, right? But you receive $15 from market. So $10 you already recorded. Look at here. $10 you already recorded as a common stock, right? But you receive additional $5. So this additional $5 is called additional paid-in capital. Okay. So if you sell 1,000 shares, $5 you receive more. Something like this. Look at another example. So the $5 will go to the additional paid-in capital. Par value $10, but the market price is $5. Do you understand? The share price is $10, and you go to the market to sell your share, and your share do not have any demand. Finally, you sell your share with $5, right? So you have a loss. $5. So when we sell our share, okay, we do not record gain or loss. Okay, we do not record gain or loss. We do not record premium on discount. We use only one account. Additional paid-in capital. Do you understand? So this is the rules for the share transaction. If you have any gain to sell your share, if you have any loss to sell your share, okay, you should not record gain or loss. You should record only one account. Which account? It is called additional paid-in capital. Now you know that gain means it is debit or credit. Gain is credit, right? Look at here. Gain is credit, you remember. And loss is debit. Can you remember this? Gain is debit and loss is credit, right? Can you remember? So if gain is debit and loss is debit, it means that additional paid-in capital sometimes credit, additional paid in capital sometimes debit, because we have both relationship, plus and minus here. So additional paid in capital, look at here, additional paid in capital, sometimes debit and sometimes credit. When additional paid in capital debit, if we have a loss, look at here. If we have a loss, then additional paid in capital debit. Okay. If we have a gain, then additional paid in capital credit. Clear? So look at here, par value. Par value we record under paid in capital. Okay. Par value we record under paid in capital. And if we have any gain and any loss, we record under additional paid in capital. Okay. So additional paid in capital means sometimes gain, sometimes loss, right? Very simple. So if you have a gain, gain is credit. If you have a loss, loss is debit. Clear? So after plus and minus, for example, this amount is just a random amount. This amount is $30,000. Just I put some random number. We do some plus and minus, and we find that additional paid in capital after doing plus and minus. Okay. After doing plus and minus, we find that our additional paid in capital is $30,000. Now, what is retained earnings? What is the retained earnings? How to calculate the retained earnings? You can show the formula. Net income, for example, $50,000. Net income. Assume that this company's net income $50,000. And who is the owner of this money? Business or the shareholders? Business earned $50,000 net income, and who is the owner of this money? Shareholder, not the business, right? So you people are the shareholder, and this business earned $50,000 net income. So this is your money, right? This is your money. But business said that, okay, this is your money, but I am not going to give you all the money today. Okay. They said that I am going to give you maybe $30,000. Okay. Business said that net income is your money, $50,000 is 100% your money, but I am not going to give you all the money today. I am going to give you $30,000. Okay. So this $30,000 is called, if you receive this money, this $30,000 is called dividend. This $30,000 is the dividend. And business said the remaining money, what is the amount of remaining money? Remaining money is $20,000, right? Business said that the remaining money, I am going to keep it, okay? This is your money, but I am going to keep it to use this money to expand the business, okay? So this $20,000 called is the retained earnings. So this $20,000 is the retained earnings. And why it is plus sign? Because it is your money. Okay, it is your money. You will receive this money in future. So this $20,000, you will receive in future from the business. That's why this is the plus sign. That's why this is the plus sign. Right? Yes. So retained earnings, how $20,000 came? $20,000 came by this. Net income is your money. From net income, you receive $30,000 dividend, right? And how to calculate dividend, what is the meaning of dividend? We learn in our chapter long-term liabilities, right? Company calculate dividend, prepaid dividend, right? Common stock dividend, and give it to the shareholder. Can you remember the formula? Net income minus preferred dividend. Remember? Net income minus preferred dividend, remaining money goes to the common shareholder, something like that. Anyway, so this is the meaning of retained earnings. And this is the meaning of additional paid-in capital. Okay? So additional paid-in capital is your gain or loss account, right? Now treasury stock. Look at, this is the minus sign, right? This is the minus sign. So what is the meaning of treasury stock? So the definition is company buy back own share. So this is the definition of treasury stock. Again, you have to remember your long-term liability chapter. Buyback bond. Can you remember this topic? Buy back the bond, right? What is the buyback of the bond? Buyback of the bond means you sell your bond, right? And 2 years later, you don't want to continue your bond. Then you will tell them that, please return back my bond. I am going to give you money back, right? Treasury stock is the same concept. Company sell a stock, okay? And company call back the stock. Company said that, do you want to sell the stock again to me? Okay, then give it to me. I will give you money back. Do you understand? The same concept of buyback bond. So look at the definition, company buy back their own shares, okay? Buy back their own shares. So let me explain in detail about treasury stock with some example. For example, this is January 1st, 2021. ABC company issue, or we can say sell 20,000 shares. And this share may be common stock or preferred stock. So January 1st, 2021, ABC company issue or sell 20,000 shares. 20,000 shares, and these shares may be common stock or may be preferred stock. Now July 15, for example, July 15, this time, ABC company buy back 5,000 shares. Okay, buy back shares from the shareholders. For example, here you paid when you buy your common stock, you paid maybe $50,000 or $40,000. Okay, so you buy it, right? And you give me $40,000. Now I request that I want to buy back 5,000 shares, okay, from the shareholders, and I am going to pay you. I am going to pay you maybe 10,000 because I purchased back 5,000. I am going to give you $10,000, something like this. Yes. So I buy back my share and I give you $10,000. So $10,000 cash paid to the shareholders. Now look at here. You give me $40,000, right? And I buy some share from you again, okay? And I give you $10,000 cash. So this money already paid. Do you understand? This money already paid to you, right? Now can you claim $40,000? You give me $40,000, okay? and you buy 20,000 shares, and I buy back some share from you and I give you $10,000. Can you claim this money again? Can you claim the $40,000 to me? You cannot claim $40,000, right? Because from here, I already give you $10,000, right? I already give you $10,000 and you return back my share. So as I already give you this money, you cannot claim this money again. So as you cannot claim this money again, so this is the minus sign. Do you understand why treasury stock is minus sign now? Why treasury stock is minus sign? Because I already give you this money and you cannot claim this money again. Okay, so this is your investment. Look at here. This is your investment. You give me $10,000, you give me $40,000. Okay, this is your investment. Now from this investment, I give you already $10,000. I repeat again, this $50,000 is your investment, okay? And I give you this $10,000 to you. So this money you cannot claim again. Okay, you cannot claim again. So after finally, this is the money, this is the gain or loss. Okay, if it is gain, it is your gain. Try to understand, you are the shareholder. Okay, if there is a gain, it is your gain, right? If it is a loss, it is your loss. Look at here. Loss is going to deduct it, right? Loss is going to deduct it, gain is going to add. So as a shareholder, if there is any gain, it is your gain. If there is any loss, it is your loss, right? So that's why we deduct gain, we deduct loss and we add gains, okay? After doing this, this is your claim. And this money, retained earnings is your money. Why retained earnings is your money? Because it came from net income, right? And net income is your money because you are the shareholder. So after doing this plus and minus, finally you will receive $90,000 from the company. I don't know the calculation is accurate or not. Anyway, so doing this kind of plus and minus, this is the final money you are going to receive. Okay, this is the final money you are going to receive after doing this kind of plus and minus. So from this table, the table is very, very important to solve the question. This table is very, very important. Why? Because we know that this is the first point. We are going to record common stock and preferred stock in credit side. Okay. Common stock and preferred stock we have to record in the credit side, and which amount? Only par value, not the market price. We have two price, you know that when we sell bond, can you remember we have two rate. One is market rate, another is company rate, right? So common stock and preferred stock always follow the company rate. So this par value means this is the company rate. Clear? Then again for the bond, we have gain or loss, right? So the share, as we are going to sell share, it is a little bit different than the bond. Okay. So any gain or loss, we have only one account. Do you understand? Before we record discount on bonds payable, can you remember? We record premium on bonds payable, but for share, we cannot do that. For the share, we have only one account. Which one? Additional paid in capital. And additional paid in capital sometimes plus, sometimes minus. Clear? So when we record plus, if we have a gain, right? If we have a gain. When you record minus, if we have a loss. And plus means it is credit and loss means it is debit. Clear? Then retained earnings is always credit and treasury stock is always debit, right? Here debit, why? Because we buy back our share and we no need to pay this money again because we paid this money again already. So now let's see some examples. So if you understand this table, now based on the tables, let's see some easy questions. See exercise 1. Again, ABC company issue 10,000 shares. Okay, company sells 10,000 shares of common stock for $1. ABC company issue 10,000 preferred stock for $1 par value for $10 par value. Okay, $10 par value. So let's see this kind of example first. Now tell me, do you understand the difference between look at PER, par value, PER, par value, and we have PAR, par value, par value. So what is the difference between these two words, par value and par value? Which one is the market price? First one, very good. So this is very good. So this is market price, right? This is the market price. Market price. And this is the company price. Now, according to this example, do we have any gain or loss? Okay, so par value equal. So we find here that par value equal market price, right? Par value equal market price. So no gain, no loss. If no gain, no loss, then this account will not come. Additional paid in capital, this account will not come, right? Why this account will not come for this journal entry? Because we don't have any gain, we don't have any loss. If we have any gain or loss, okay? If we have any gain or loss, then this account will come, otherwise not. Now, how to record journal entry for this? How to record journal entry up to here? So this is our question, right? This is our question that ABC company issued 10,000 common stock, $1 par value for $1, and ABC company issued $10,000 preferred stock for $10 par, but we have par value $1 and par value $10. So what is the journal entry? So you have to follow this format properly in the exam. So date, accounts titles, reference, okay. So if we want to record common stock first, I already mentioned in the table that common stock and preferred stock come from paid-in capital, right? Common stock and preferred stock come from the paid-in capital. So paid-in capital credit, so common stock also credit, right? So common stock also credit, and common stock always follow which price? The company rate, right? The company rate. So common stock here, common stock is credit. Common stock is credit, $1. The par value is $1, right? So how many common stock we sell? We sell 10,000. We sell 10,000 common stock, $1 par. So $10,000 is credit. $10,000 credit. And when we sell common stock, like bond, when we sell bond, we receive cash, right? From the market. So cash debit. Cash debit. And this is not the par value. This is the market price. This is PER. Par value means market price. Market price. And we write narration. Record the issue of common stock and debit $10,000. So here we have no gain, no loss, right? No gain, no loss. Why? Because market price $1, market price $1, company rate also $1. $1. So no gain, no loss. Clear? So we done this part. For example, FPC company issue. Okay, so I can write a date on January 1st, 2022. So this is the date first. So this is the date. And reference, you no need to write anything in the reference. So this is the date we sell our common stock. On July 1st, we sell preferred stock. So July 1st, we sell preferred stock. Again, preferred stock, look at here. Common stock credit, preferred stock also credit, right? Preferred stock also credit. So we record preferred stock credit. We record preferred stock credit. We sell 10,000 preferred stock for company rate. Company rate is $10. Look at here. The par value. Par value is the $10 company rate. Prepaid stock credit. Okay. So it is something like $100,000. Clear? Look, common stock credit, par value, right? Company rate. Preferred stock credit, company rate. And company receive cash from market, the same amount. Company receive cash market from same amount. Also, they sell $40. $40. So no gain, no loss. No gain, no loss. Preferred stock. So do you have any question for exercise 1? Company sell common stock credit. Company sell preferred stock credit. Okay. And common stock and preferred stock always follow the par value. That means the company price. But when we receive cash from market, we record market price, right? But the point here is market price and the company price similar. Okay, market price and company price similar, so we don't have any gain, we don't have any loss. Clear? Now look at exercise 2. So assume that on January 1st, ABC company issued 2,000 shares. Issued 2,000 shares of common stock. Okay, 2,000 shares common stock for 2,000 share of common stock for $55. $55. And the par value of common stock is $50. Think up to here. This is the information. This is the information. On January 1st, 2022, ABC company sell 2,000 shares of common stock, okay, for $55 par value. This is the market price, right? Par value is the market price. But what is the company rate? Company price, that means the par value is $50, right? $50. So now we have to think about whether we have any gain or loss. Par value is higher, right? Or lower? Par value is lower, right? But market price is higher. So we have gain or loss here. We have gain, right? We have gain. We have gain. Clear? So gain. So I told you that when we have a gain, okay, we cannot record. We cannot record gain. We cannot record premium. Gain means premium, right? Gain means premium. Gain means premium. But when we sell our share, we cannot record any gain. I mean, we cannot record the word gain. We cannot use the word premium. We have to use a specific account. It is called additional This is the account we are going to use. Clear? This is the account we are going to. We cannot record gain, okay? We cannot record premium. We are going to record additional paid in capital. And can you remember, if it is a gain, it is a good news or bad news for you? Good news, right? Good news means it is going to add with your money, right? This is going to add with your money. So plus sign, this is the plus sign and it is credit. Okay. So let's see the journal entry. For exercise 2. So we sell common stock. How many common stock we sell? We sell 2,000 common stock, right? And what is the company rate? Company rate $50, right? $50. The par value is $50. $50. So how much here? It is something like $100,000. Clear? We sell 2,000 common stock, right? It is 100,000. Yes, 100,000. Now, how much cash we receive? We sell 2,000 shares. We sell 2,000 shares, and from market we receive $55. It is 110,000. Do you understand up to here? Do you understand up to here? Our common stock price, look at here. Our common stock price is $100,000, right? But when we sell it from market, we receive $110,000. That means we have a gain, right? We have a gain. And as we have a gain, we cannot use this word, right? We cannot use this word. Which word we have to use? We have to use this title, additional paid in capital. Now, additional paid in capital, which part you have to record it? Debit or credit? Credit, right? Additional paid in capital, now $10,000. 10,000. Clear? Okay. Now look at another exercise, the same one. On January 1st, ABC company issued 2,000 shares. Okay. 2,000 shares for $45. Okay, you sell 2,000 shares. And for how much? For $45. So this is the market price. Okay. But we know that the par value of our common stock is $50. Now, good news or bad news? Your company price $50, but from market you receive only $45. So par value is greater than the market price. You have a gain or loss? We have a loss. Loss means we sell it premium or discount, we sell it in discount. We sell it in discount, right? We have a loss. Again, if we have a loss, we have a discount, we cannot use this word. We have to use which word? We have to use additional paid in capital. Okay, like here. Now I copy this, look at here. I copy this one. You can see we sell. Now I delete this column. Delete this column first. Let's see. So we sell 2,000 shares. Par value is $50, right? Par value is $50, and it is $100,000. But from market, we receive $45. From market, we receive $45. That means from market, we receive only $90,000. Clear? Our common stock price $100,000, but market give us $90,000. So we have a loss, right? Loss means additional paid in capital now debit. Look at before additional paid in capital credit, right? Now additional paid in capital is a debit. Additional paid in capital $10,000 is a debit. Now we can compare these two together. You can compare exercise 2 and 3 together. It will help you to understand more clearly. We see here that additional paid-in capital credit. Again, we say that additional paid-in capital debit. Clear? So this is for gain and this is for loss. This is for loss. Any question? Okay, so if you don't have any question, that's all for today.